Today is July 31st, 2025. Many people believe that a high income is the only ticket to an early retirement. They think you need to be a doctor, a lawyer, or a tech executive to escape the 9-to-5 grind before you're old and gray. This is a dangerous and widespread myth that keeps people chained to their desks for decades longer than necessary. The real key to financial freedom isn't about how much you make, it's about how much you keep. Your savings rate, the percentage of your take-home pay that you save and invest, is the single most powerful lever you can pull to accelerate your journey to retirement. It is the metric that truly matters. Think about it this way. A person earning $200,000 a year but spending $190,000 is barely making progress. They are on a high-speed treadmill, running furiously, but essentially staying in the same place financially. They might have a fancy car and a big house, but their financial independence is a distant dream. On the other hand, someone earning a more modest $60,000 a year, but managing to save and invest half of it, is on a rocket ship to freedom. Their lifestyle might be less flashy, but their wealth is compounding powerfully behind the scenes. This simple mathematical reality is often ignored in our consumer-driven culture. The core principle is that every dollar you save serves a dual purpose. First, it directly increases the size of your investment portfolio, bringing your retirement goal closer. Second, and just as importantly, every dollar you don't spend lowers the total amount of money you will need to live on in retirement. This creates a powerful synergy. By consciously reducing your spending, you are simultaneously building your nest egg and shrinking the size of the nest egg you'll ultimately need. This is how you can drastically shorten your working career from the standard 40+ years to a mere decade. So the first step is to shift your entire mindset away from a focus on earning more and toward a focus on saving more. It's not about deprivation, it's about efficiency and intentionality. It's about questioning the default spending habits that society pushes on us and realizing that true wealth isn't about having more stuff. It's about having more time and more freedom. Your savings rate is a direct measure of how much freedom you are buying with each paycheck. The higher that rate, the faster you are purchasing your own life back from the demands of mandatory work. To embark on this journey, you need a destination. In the world of financial independence, this destination is often called your FU number. This isn't just a flippant term, it represents the exact amount of invested capital you need to have the freedom to say FU to any situation that doesn't serve you, whether it's a bad boss, a toxic work environment, or a career you've outgrown. It is the financial fortress that allows you to live life entirely on your own terms. Calculating this number is the critical second step, as it transforms a vague dream of retiring early into a concrete mathematical target that you can actively work toward. The first part of finding this number is to determine your essential baseline. This is not a complicated financial analysis. It is simply the bare-bones annual cost of your survival and basic comfort. You need to comb through your expenses and figure out the absolute minimum you need to cover your most important bills. Media group, person sorting utility bills, rent receipts, and grocery lists on a table. Close-up of hands using a calculator with bills spread out at stock at distribute _equally. Housing, utilities like internet and electricity, your phone, and food. This isn't your budget for lavish vacations or fancy dinners. It is the cost of your foundational needs. For example, you might find that your rent, bills, and groceries add up to $2,500 per month, making your essential baseline $30,000 per year. Once you have your essential baseline, you can then determine your more comfortable annual spending target. This might include some funds for travel, hobbies, and other discretionary items that make life enjoyable. Let's say you decide that an extra $10,000 a year on top of your baseline would provide a happy and fulfilling retirement. This makes your target annual retirement income $40,000. This is the number you will use to calculate your ultimate FU number. It is crucial to be honest and realistic here, as this figure will dictate the size of the mountain you need to climb. This process of defining your spending is incredibly empowering. It forces you to confront your consumption habits and decide what truly brings you value. Many people are shocked to find how much money they spend on things that don't genuinely contribute to their happiness. By identifying your essential baseline and your ideal spending, you create a clear financial map. You now know exactly how much it costs to run your life, which is the foundational piece of information you need to build a plan that can set you free in a surprisingly short amount of time. With your target annual retirement income defined, you can now calculate your total FU number using a beautifully simple and time-tested guideline known as the 4% rule. This rule of thumb, backed by historical market data, states that you can safely withdraw 4% of your initial investment portfolio each year without ever running out of money. The idea is that your investments, ideally held in a broad market index fund like an S&P 500 fund, will grow at an average rate higher than your withdrawal rate. Historically, the market has returned around 10 to 12% annually, so a 4% withdrawal allows your principal to stay intact and even continue growing to combat inflation. The calculation itself is straightforward. You simply multiply your desired annual income by 25, which is the same as dividing by 0.04. Let's use our previous example. If you determined you need $40,000 per year to live comfortably in retirement, your FU number would be $40,000 multiplied by 25, which equals $1 million. This means you need to accumulate a $1 million investment portfolio. If your needs are higher, say $100,000 per year, you would need a $2.5 million portfolio. This simple math demystifies the entire concept of retirement planning. It gives you a single, clear, and achievable goal. Your retirement portfolio is the engine that will power your freedom. For most people pursuing this path, the simplest and most effective strategy is to invest in low-cost, diversified index funds. These funds, such as those tracking the S&P 500 or a total stock market index, provide broad exposure to the economy's growth without requiring you to become a stock-picking expert. You are essentially buying a small piece of hundreds of the largest and most successful companies. This passive investing approach is low-maintenance, cost-effective, and has historically proven to be a reliable way to build wealth over the long term. The beauty of this strategy lies in its simplicity and accessibility. You don't need a fancy financial advisor or complex trading strategies. You just need discipline and consistency. By setting up automatic contributions to your investment accounts each month and letting the power of compounding do its work, you are methodically building the machine that will eventually pay for your lifestyle indefinitely. The 4% rule provides the blueprint, and low-cost index funds provide the building materials. Your job is to supply the capital through a high savings rate. The final piece of the puzzle is understanding the direct and dramatic relationship between your savings rate and your retirement timeline. This is where the magic happens. Starting from zero, achieving a high savings rate can shrink your working career to an astonishing degree. Let's look at the numbers. If you save a conventional 10% of your income, you are looking at a working career of over 33 years. Doubling that to a 20% savings rate shortens the timeline to about 25 years. These are the timelines that most people consider normal, but we are aiming for something much faster. The real acceleration happens when you push your savings rate into truly ambitious territory. If you manage to save 40% of your income, your time to retirement drops to just over 16 years. This is already a massive achievement, cutting a typical career by more than half. But the magic number for a retirement horizon of approximately 10 years is a savings rate of 50 to 60%. By saving more than you spend, you reach a tipping point where your money starts working harder for you than you work for it. A 60% savings rate, for instance, can allow you to reach financial independence in just about 10.3 years, even starting from a net worth of zero. The biggest enemy on this path is a phenomenon known as lifestyle inflation. This is the natural tendency to increase your spending every time your income goes up. You get a raise, so you get a nicer car. You get a bonus, so you buy a bigger house. This is the trap that keeps even high earners on the hamster wheel. To achieve a high savings rate and retire in a decade, you must consciously fight this urge. The key is to keep your lifestyle pegged to your essential baseline, or slightly above, and funnel every single raise, bonus, and salary increase directly into your investments. This strategy turns your rising income into pure investment fuel. Imagine starting out with a 40% savings rate. When you get a 10% raise, instead of upgrading your lifestyle, you maintain your spending and boost your savings rate to nearly 50%. This single decision can shave years off your working life. It requires discipline and a clear vision of your goal, but the reward is immense. By rejecting consumerism, calculating your FU number, and committing to a radically high savings rate, you are not just building wealth, you are buying back your most valuable asset, your time.